Sexy.
Do you want me to just leave it on, or do you want me to
I'll
share once
just
we
take
get
it
into it?
off for now if you don't mind.
Sounds good.
Thank you. All right, is everybody ready? Get this party started.
Let's rock and roll.
I had some theme music, but we'll have to leave that for another day. My DJ routing skills aren't quite adequate yet. Good morning, everybody. We are live on YouTube and live on Zoom, and I'm very excited today about our workshop. We're going to be double dipping on protection. So I just want to let everybody get into the room here. Good morning, Austin, Barry, Billy, Bobby, Brent, Carrie, Carter, Cole, Dane, Dennis. You got the right day now, Dennis. You're live in the room. Good morning, Garnet. Garnet, you were the man that inspired this. We had a good chat. Good morning, Greg, Eileen, Jared, Greg, JD, Justin, Kevin Hirsch. Good morning. Kyle Bordis, good morning. Matt Dixon, Nathan, Richard. Great crowd. Ryan, Sean, Stephen Moran, or Moran. Stuart McMahon. Good morning, everybody. Good morning, Tracy. Well, welcome to Growing the Future Productions Live. I'm your host today, Dan Aberhart, and this is a live working session. So as always, we have an opportunity for you to ask questions in the Q&A or the chat at any given time. But today we have a wonderful group of panelists today to walk us through how you can protect yourself twice in a time when, yeah, things are a little bit wild out there, lots of ups and downs, and lots of crazy stuff happening in the world. So we have Ryan Bonnett on the call. He's been trading futures and coaching farmers through options for 20 years. Good morning, Ryan. You're looking great. I was wondering if you're going to wear your nightclub shirt, but obviously you've chosen to go a little bit more professional today. You're on mute there, champ.
Just a Superstore collared shirt today, guys.
Okay, well, keeping it real. You got to buy some options. So you got to trade in your shirt at Value Village to buy some options today. Double dipping there. Thanks for coming on, Ryan. We're going to have a great conversation. And David Sullivan, he runs production insurance at GARS. Good morning. How you doing?
Morning, Dan. How you doing?
It's going well. It's going well. And Derek Tallon, for the producer perspective, he farms in central Saskatchewan. Just sold 400 tons of canola last week, so he's got a little spring in his step. How are you doing?
Yeah, good, Dan.
Good. Yeah, it's exciting to have you on. I think you're a longtime listener, first time caller, perhaps. So
Mhm.
I want to set the expectations today that we're going to have Ryan present his thesis. And this came out of a conversation I had with one of the GARS advisors after our last session who said, I can do this, this, and this, and this, which makes it more efficient to use options. And I've always been a big fan of options in the market because we are always long as producers, always long, and to some degree or another. And this is a way that you can use tools in your toolbox to hedge that. And not only that, but we could add a layer of production insurance, counting the options in that regard. So I thought it was kind of a magical thing. It was a reminder of what's possible. And so Ryan's going to walk us through that thesis of what he did in real life with his clients last week. This is a real world scenario. Canola's been going up really nicely, but when will it stop? When does the train stop? We don't know, but we can use these options and production insurance to hedge against a big drop or lock in some of those prices or manage our essentially our gross margin through these tools. And then just like in the conversation yesterday, we want Ryan and Derek to role play a little bit, talk about some of the moves that Derek made in the market recently with his inventory, to give you a behind the scenes of how Ryan might work with his clients and talk to his clients. And then once we get through that, then we're going to hear from David. He's going to layer on that production insurance angle. And as I say, please ask your questions. This is for you to learn, to get the most out of it. And with that, Ryan, do you want to take us away and elucidate how you made a play and how you could potentially make plays going forward? I don't know if that scenario is still available. It's been
Yeah.
a volatile market, but take it away.
Yeah, you betcha. So just quick kind of background for me, folks. Been trading for about 20 years. And, in the last 5 years, I guess the reason why this conversation got going is I kind of realized no one's actually helping farmers walk through these type of situations. So if you get a new chemical, you got a rep coming out talking to you. If there's something new on your combine, they bring you into a combine course, you know, at the dealership. No one walks people through these type of options. No one's looking for these type of opportunities in the market and, you know, bringing it up to you when, you know, when it's available. So I got kind of tapped here to do this, and I'll share my.
When you said there's only a small handful, literally, of folks that are doing what you're doing as far as being very specific on what to do and when to do it.
Yeah, so there'd be 5 or 6 different brokerage firms around Western Canada that you know, would be calling out the farmers to say start doing these type of things, and then there's a select amount of advisors out there as well, I think, that understand these things well enough. Now, the only thing here I'd say with any broker that you're using, they're all really great guys, but I find they have a hard time kind of connecting your cash sales in with your, you know, hedging, because you don't always have to hedge. You don't always have to take these opportunities. But if there's ever a time when, hey, this is a great price, but I just don't feel comfortable selling this to an elevator, is there some other way that you can do that, secure that price without actually having to take that contract with the elevator? So I think there's just
And we
fewer folks
wanted
that can walk into it.
we wanted to get a feel for where everybody was at. We have some polls here. Do we want to launch that first poll now, Ryan, or we want to save it about bullish bearish on canola?
You know, we could probably get through my first probably
Sure.
2 or 3 slides, and then it's probably
Love
a
it.
pretty opportune time there.
Okay,
So,
you tell me when to launch it, and then I'll click the button.
okay. All right, so I'll just kind of kick this off here a little bit, and then yeah, turn it over back over to you there, Dan.
Sounds great.
All right, so what we're going to be covering here today, guys, you know, what are call and put options, and how and when do you use them properly? How do tools like put options fit into your grain marketing plan? How would one use a put option strategy to secure current pricing? Specifically for new crop canola, that's the one that we talk about here in Western Canada all the time. And then another key thing that I always get brought up about is like, hey, some of these options are really expensive. How do I cheapen these things up? And then when should somebody get into strategies like this? And then how do you get out of them once you're in them? So cover a few of those things. So before we get into, you know, the poll that Dan talked about that he sent out there yesterday, key thing I always try to, you know, get across to people, and when I first start talking about this one is just the concept of bullish and bearishness. Okay, so this is super simple. You guys have probably heard this before, but I'm going to walk through it. You know, being bullish means that you believe the market is going to go up from this point in time, current price levels, to another time in the future. So you can be a short-term bull or a long-term bull. You can be a short-term, and on conversely, you can be a short-term bear or a long-term bear. Different time frames on that side. So that's really, really key. You can pick any particular market, and you could say, hey, maybe I'm bullish oil, crude oil for a short term, but I'm bearish for it long term, as an example. Okay, so this is key because you can't really jump into a strategy until you have a premise that you've built based on your particular bullish and bearishness. Okay, so the next section on now, and I always say to folks is, it's okay to be bullish or bearish. There is reasons and arguments to be bullish and bearish on any market at any given time. But the key thing here is the next step on this is, why are you bullish or bearish on any given market? Okay, so I'm just going to use canola for an example right now. Hey, I'm bullish canola because the Iranian war is going to drive oil prices up to 150, and I think canola is going to work its way up with that. Okay, you can be bearish canola as well. You could say, hey, we've had a $160 run since January on this thing. Market's getting overbought. Basis levels are widening out. We're going to plant a lot of canola next year. I think canola is going to go down. Okay, so I might be bearish. Both are very logical, valid arguments right now. Now, the next step on that one, I always say to folks is, can you quantify your level of bullishness? So if canola futures are trading at 730 right now, are you bullish to 770? Are you bullish to 800? Are you bullish to 900? Quantify your opinion now. So that's the tougher thing. A lot of folks have a hard time doing that one. And it's exact same way on the downside. If you're bearish the market, no problem. Are you bearish it down to 650 to 600 to 550? So quantify your argument there as well too. So you can't really get into any of these things before you start kind of thinking like that on that side.
And are you
So
going to share how bullish or bearish you are today?
yeah,
For free?
I'm
For
actually
free
going
on
to
the
put out
call?
some. I'm going to put out some charts, and I'm going to make some arguments on this one. And some logical arguments. So, that's pretty good segue in terms of the survey there, Dan.
Perfect. Do we want to launch that here shortly then, or?
You could launch it right now if you like.
Right now, let's do it. Okay. Where are you at? Where's your head at on canola prices right now? Are you bullish? I think we're going to go higher, where the bull is using his horns to go up. Or are you bearish, where the bear is using its claws to strike down? I think we've seen the top or close to it. Neutral, it could go either way, or honestly, I don't know. What do you think? What's the panel thinking here? Are you? I mean, it was a beautiful chart, but then we had quite a severe retracement, gave back quite a bit of gains, but it's still going. I mean, oil's still running, tied to oil. What's your thoughts?
I'm the insurance guy, so I'm always bearish.
Oh,
I see
come
risk
on, don't ruin the
everywhere.
party. Yeah, you see risk everywhere. Ryan, where you? How far could this bull market run in your estimation?
Yeah, so if I'm looking at the market right now, I
Yeah,
generally will go by historic references. So generally, when I'm looking at the market right now, I think if I'm bullish, I could be bullish to the yearly highs, which was in the summer, so call it about a 760 futures. And we've already challenged that once here in the last couple weeks, but we reverted real hard off of that. So I would say to somebody this, if I'm bullish, I'm probably bullish into that 760 range, and then I'm going to readjust my commentary after that. So if we
interesting.
blew through that range, then I'd have to go look back in the charts to see, hey, what's the next level that I could probably be bullish to logically and quantifiably? Okay, now the further you go back in the charts, the less valid they are because it's a historic type of thing, but it's the best reference we have. So I always will make my opinion known, but I'll always have it based in, in data back type of situations like that. So I've got this chart later on in the presentation, but again, if I'm bullish canola right now, I'm probably bullish to 760. But if we blow through 760, your next logical place from there is probably something like an 830 to 850.
And how bullish do you think the crowd is as a percentage? Because I actually have that data.
I don't know actually.
Anyone want to guess?
I'd say
32%.
Yeah, I was gonna say it's almost probably equal splits.
Yeah,
Okay.
it's 32%. Can you see that?
Yep, just popped up.
So we've got 32% think we're bullish and going higher. 26% are bearish, thinking we've seen the top. And neutral is 34%. Honestly, is 8%. We should probably have a category in there that says depends on what Trump tweets.
Yep.
It's a very accurate statement.
Interesting. Okay, continue on.
All right. So it's very interesting. I think that's all valid. People are bullish for a reason. I'm sure they're bearish for a reason, neutral, those type of things, all fine. Bulls and bears make money in any market. Like, make no mistake about it. Okay, so again, you're asking like, hey, what could we be bullish to? So this is a chart. I call this a naked canola chart. The reason why is there's no technical analysis sitting on here. So if somebody's looking at this chart, it's hard to give some context to where you could be bullish or bearish to. Okay, it's like, all right, well, I think this or I feel that. That's fine, but facts don't care about opinions. Facts don't care about feelings. Hey, let's put some actual, like say, a quantifiable data in there. So I'm a big believer in using, technical analysis to be able to make some of these opinions. You start putting in it, you start putting some real, objective numbers in there. So this is just a chart where I put a few just basic technical analysis points on. Okay, so I'm going to start from the top and work my way down. So this black line on top, this is our current overhead resistance line. And this is just a simple line drawn from the top of what the prices were in the middle of summer. Back when we had a very small carryout, people were concerned about their crops. Hey, we hadn't had that rain yet. We had this big run up here in the middle of summer. It was an excellent time to be marketing grain. And then I still remember the weekend we got, I think it was in June, we started getting about 5 inches of rain across Alberta and in central Saskatchewan. And ever since then, we kept getting more rain throughout July and August, and this market just, crumbled down throughout the year. Okay, so that was the top of the market. At one point in time this year, after harvest, we got down into that, call it $600 or just sub $600 range on the chart. So that would be kind of a low end, and that's here right after harvest here, down this 600 range, and then we challenged it again. So that's our low end of the chart. If you really want to go back a couple, a little bit further back at the low, when China put on their tariff policy on us, we actually got down to around 550, 560. So again, these are just objective places on the chart where you start drawing lines. So at the top of the market in the last year, the bottom of the market in the last year, pretty good ranges. So the next one that I would kind of put to here, and this was once resistance, but it's now support, is right in around this $660 range. Okay, so the reason why that one is there is because that was a high of the market after harvest, right before the Stats Can report that cratered us down into that low 600 range. Now, since then, we've had an amazing rally, almost too good of a rally, and we've worked ourselves all the way up here into that kind of, low $700 range. Okay, so these are just basic support and resistance lines. The pink and green line, what I have on here is the pink line is a 100-day moving average, and the green line is a 200-day moving average. So the reason why these lines are on this chart is because every trader in the world that trades against farmers, and I'm not saying they're bad people if they trade against you, but your brokers, your elevators, your crushers, these guys will all have these moving average lines on this chart, on their charts making these decisions. So again, these are just, again, basis. These lines will tell you, hey, are we in an uptrend or a downtrend? Okay, so again, just basic kind of, parts on the chart. And then down here on the bottom, this is what we call a momentum indicator. And this is, I particularly use relative strength index. It's just one of the different oscillators that you can have out there, and it tells you if the market is overbought or oversold. So these blue kind of lines above here, down here on the bottom of this chart, that would indicate to us that the market is overbought. There's been more buyers than sellers over a period of time. And that generally should be a watch out for people. If the markets get overbought, they likely should come down, just like if they get oversold back here in January, it's likely to go back up. Doesn't mean it's got to move back up in that immediate day, but again, it's just an indicator to say, hey, are we getting too high or too low? Okay.
Ryan,
So
are you
again,
able to adjust that screen to enlarge the charts? Because I just had a comment here that I think what we're getting on your share is presenter mode, not to interrupt your flow, but
oh,
I think
okay.
people are just wanting to zoom in on that chart a bit if you can. If not, that's
Yeah.
fine. But thank you for that comment, by the way. Sometimes I know if you got multiple screens, it can be a little bit difficult to get it full screen. It's not a huge deal, but I feel like this rally's been a little bit premature. And of course, there's all kinds of geopolitical and news type things that are stoking it. It's good to know that canola wanted to go there, and it's good to know too that in your professional opinion, I think it could go a little bit further. But question
Is this
is, what?
better?
That's so much better. Thank you.
Okay.
Thank you,
No
Turner.
problem. Thanks
Keep
for
going. Yeah.
pointing that out there.
I did
Okay,
have
so
a
yeah.
comment too that maybe you can weave into this
Yep.
because I appreciate the comments here from Dean York. Futures are one thing, but $70 basis has killed the net price for buyers to cover all risk. Buyers are talking price to the farmer with a fat basis. $50 a metric ton new crop basis is not the norm at this time of year. Is it not?
Yeah, and I'd comment this on basis. The wider the basis is, generally the buyers are saying, hey, we don't need this much canola. That's the general comment. So as the bases have gotten worse, as we've appreciated in this, that tells me buyers are more reluctant to buy these higher prices than they currently are. Now, as the markets go up, those buyers are more likely to be able to convince farmers to take those bases because the net price is still above $15 a bushel. So by no means are bases good. I think they're atrocious historically right now. But if you compare to, if you're near 730, 740 futures, a 60 under basis is junk, but it's better than a 500 futures with a 20 under basis. Sometimes you can't get both, is what I probably try to convey to everybody.
Is that a bearish indicator in itself?
Well, one day of a basis is not a bearish indicator. More what you'd look on a basis is how is the basis trending over time. If the basis is appreciating over time, that is a bearish indicator. If it's getting better over time, that's more of a bullish indicator. So it's not necessarily a 60 under today, which I would look at to say that's bullish or bearish, but what was it last week? If it was 50 under last week and 60 under this week, that's a bearish indicator. Now, if it's a 60 under this week, but it was a 70 under last week, that would tell me that's a little bit of a bullish indicator. But it's not the particular day, 1 day basis doesn't mean anything. It's what's the trend doing over a period of time.
That makes sense. Well, I'm glad you're watching all this because it's complicated.
Yeah, I'd get on my soapbox to talk about export policy at some point in time if
Let's
people
do
would
it.
listen.
Let's
But
do it. Yeah, let's make another episode.
yeah, we could do it. It would actually be a really good one for you, Dan. You'd probably get a lot of people excited about it. But
let's do it. Let's do it. I love it.
all right.
Turner's asking, how do you and other producers keep track of local basis bids? Is there someone or somewhere it collects beans collected and aggregates? How do you track that?
Yeah, there's a few different advisory firms that will look at that. Generally, what folks like me do is there's a group of us that are independent advisors that we talk on a pretty much weekly basis, and we share what our local bases are to try to track them. So there's not exactly a website where you can do it, but the best way you'd probably be able to do it as a producer is tracking it yourself across your 4 or 5 buyers that you might have access to in your current geography. Now that is limited though. What you really want is an aggregate Western Canadian basis. So the tough thing about that is, what I mean by that is that if you're in Saskatoon, your basis could be getting worse, and whereas if you're in Lethbridge at the exact same time, your basis could be getting better. Now, those are just two different market geographies. So the aggregate point is the bigger one that you want to be tracking, but that is more difficult to track. You need a network to be able to do that.
Thanks for answering that. Greg Bosch was asking how many people polled. We have 90 on the call, 94 on the call, and I think we had 50 or so answered. Barry Rutledge is saying, slide 6, see a gap just above the 659 line. Do you believe that will always fill that gap? Ooh, we're getting into trading technical lore. I love it.
So short answer is yes, the markets will always kind of fill a gap. It's just when. So does that mean it needs to be immediately done? What I'd be more looking at this one is how quickly does that gap get filled? So whenever there's a gap in the charts, and there was a gap in the crude oil charts not too long ago, got filled pretty quick. But the longer it takes to fill that gap, the more likely we're going to aggressively move towards that gap, in my opinion. There's a few different gaps in these charts as well, in these longer term charts.
All right, thanks for fielding those questions, Ryan. We're all caught up, so giddy up on the rest of your presentation here.
Yeah, so we're asking, hey, am I bullish or bearish on this one? So here's a chart of what I mean by this one when I talked about it before. So I always try to quantify my opinion on this one. I never try to use, well, I think this or I feel that. Like some of that does leak into there, but if you can really try to push those things aside and use quantitative analysis to do it, you're going to improve in your marketing. So here's what I mean by this. So here is our previous high in July this past year because of, tight carryout and bad weather. We've now appreciated up into that level. Now remember, we still have a pretty large carryout in canola this year, guys, and the last reports were about 1.9 million tons behind export pace. So that has to give you some type of pause here. But if I'm bullish, if we're 625 and we run up to this 650, 660 range, if we blow through there, the thing I would probably point out to everybody is the next reasonable place this market could rally to is up into these two previous highs that were from August of 2023.
Wow.
Okay.
You think that what over under are you thinking on that, man?
Well, tell me what's going to happen in Iran tomorrow, and I'll tell you what I think. So far, I've been seeing every morning I wake up and there's some new oil and gas field that's on fire, and it seems like that thing's going to escalate. So it's tough not to say, hey, it's to be bullish here. Now, the only holdback I have is we do have a massive carryout in canola. We've got a large production of soybeans in Brazil. So fundamentally, we shouldn't be rallying the way we are, but war kicks out any fundamentals. So it's easy to say, hey, I think this could happen percentage-wise, But the straight up fact is like without that war, I'd probably be able to give you a more definitive answer what I think. But with this war, this is absolutely possible.
Could
But
we
if this war
say,
stops, we've got downside. So,
could we say war trumps fundamentals? If we wanted to
100%,
use a dad joke in there. Okay. Let's check
100%.
it. All right.
Yeah, exactly right. So, so again, bullish or bearish, put some context to it, put some arguments to it. Again, if we blow through this number, I'd put it to you like this on a technical standpoint. There is no meaningful levels of resistance between 750 and 820 and then 850 again. There's nothing on this chart that would stop us in terms of like price historic, maybe right here at about a 760. But I would say that was just that would be a very temporary time.
It's so easy to be bullish at the top.
Yep.
It's hard to be bullish at the bottom. But what I'm seeing is what happens if we're actually at resistance and it's going to go back to support, which is your line way down there. How would you feel then? And if you did nothing?
Exactly right. You have to, as a market participant, you have to start thinking is like, hey, what am I more worried about or what am I more concerned on? If we crank up here or if we revert back into some of these kind of lower ranges here down there.
What if there's a way that we could protect our downside at 700, but leave upside to 800?
That's a great segue there, Dan. Perfect. Okay, so I'll get into a little bit more of the meat and potatoes. So that context there, guys, you got to have a bit of a market context, what your opinions are, where the market's going to go before you can make any of these, any of these type of things. So I'm going to go quickly through what these things are. First off, call options. It's a financial contract that gives the buyer the right to buy an underlying futures contract at a strike price on or before the date of expiration. Okay, so essentially this just gives you, again, the right to buy at a certain one. So if I was looking at May canola right now at the money strike prices, so 730, we're going to say that's about where the market is. To buy a 730 call option right now is about 24 or 25 bucks a ton. And here's what your Julys are, and this is what a November is at this particular time. Now these fluctuate, so if you've got your option market up here right now, it's going to be a little bit different. I built this yesterday afternoon. But again, these are essentially the prices to buy a call option. So the reason I'm going through calls, I'll get to that in a second. A buyer can either buy or sell a call option. You don't just have to buy it. You could choose to sell an option if you wanted to as a producer. I know Dan does some option trading. I think you've sold a few call options in your day, Dan.
I'm a seller. I'm a seller of premium. Yeah, working on it. Yeah, no, it's awesome.
Okay, there's a certain tool to be used at a certain time.
Yeah.
So generally, if someone buys a call option, if they're bullish, you think the market's going to go up and you want the ability to buy at a lower price. Generally, if somebody's bearish, they might sell a call option. For an example, if I was bearish canola, hey, I don't think canola is going to rally at 800 bucks. I'm going to sell an $800 call option and I'm going to collect $10 or $15 of premium because I don't think that's ever going to land in the money. I'm just going to collect that insurance premium and I'm going to put that in my pocket and take the profit. Okay. So the value of these options, so this 24, 37, or $47, a lot of times people say, well, what is that built off of? So these premiums are, of an option is determined by factors like intrinsic value, volatility, time to expiration, and then a whole bunch of complicated probability equations that get built into these option values. So I'll give you an example right now because there's so much volatility in this market. There's so much kind of chaos going on right now. Volatility and probabilities, those are oversimplified versions of that pricing that I've talked to you about. The people that are selling these want more premium because they're taking on more risk as a quote unquote seller of an option.
Well, it's funny when you're a seller of premium, you have to recognize you're selling that risk, like you're accepting the risk. Somebody's paying you for taking on that risk. If you're selling a put or selling a call. And I just want to pause there. And I would be curious what you think, Ryan. I'll let you continue here, but I want to launch another poll here about how people are using futures and options. So have you never used them? Have you heard of them but never pulled the trigger? Do you use them through an elevator? Do you have your own trading account or do you use them regularly with an advisor? and I'll get this poll information here right away, Ryan, but just continue talking about this. And I want people to be thinking about, where are you at? Are you using these tools? How would you need to get using them better? Do you have someone like Ryan in your life? I guess there's only so much Ryan to go around, but go ahead, Ryan. You're on mute there.
Okay. All right. No,
Keep rolling. Keep rolling.
exactly
I'll
right.
share these after. We did have a question here from Carol Strobel. For what size farm is this cost effective? That's an interesting question. Is it tied to farm size?
In my opinion, no.
Wow.
Canola
Okay.
contracts trade for only 20, they're only 20 tons of contract. So you can, in my opinion, anybody over a 500-acre farm should be able to utilize these for risk management. It's just another, it's just another couple contracts. Whereas something like a US option, something like soybeans, corn, even wheats, those are 5,000 bushel contracts. So sometimes smaller farmers have a harder time utilizing those ones, but something for canola, very easy entry for almost everybody that I would know.
You could scale it exactly to your risk in the bin, right?
Exactly right. Exactly right.
I could share these results quick if you like. So we've had
Okay.
15% of folks that's never used options. We have 31% of folks that have heard of them, but they've never pulled the trigger. That's the largest segment. We have 13% use them through an elevator. 27% of folks, 15 out of 55, have their own trading account. Good for you. Hopefully you haven't blown it up a few times like I have. Learning the hard way. And then use them regularly with an advisor. 24%, that's high. That's good. That's good.
Even with only 55 folks on here, that's actually a very high percentage of folks
Yeah.
that do have their own trading account and use them regularly. So kudos to you guys. Well done.
Well, it's
Well
probably
done.
those folks tuning in,
It's
that know
true.
the value of it for sure. So
It's true. I ask brokers on a regular basis, like what percentage of farmers do you think use these? Most of them have single digit, numbers back to me. And then even ask them this, of your
wow.
clients, how many of them actively trade? And, they might have a book of 200 or 300 different, farmer clients, and they say probably 30% might actively trade.
Well,
So,
and if you're a 5,000 acre farmer, how long the market are you with wheat and canola?
yeah, great question.
A lot. The answer is a lot. I've not, probably David can think about that and do some math there with OpenAI or something, get back to us. But you think about it, it's essentially your net revenue that you're long one way or the other. So continue on there. Thank you. I think we're making headway.
Okay. So, talk about call options. Now, put options, this is the one most farmers would probably be the most interested in, because you're naturally long, you got to be thinking about selling and protecting the downside. So, a put option is effectively the opposite. It's a financial contract that gives the buyer the right to sell the underlying futures contract at a strike price on or before the expiration date. So essentially, you would use one of these if you are bearish the market. You would buy one if you are bullish, or sorry, if you're bearish. If you were bullish the market, you might sell one. You might sell one out of the money because you think, hey, I would like to buy something back down there if that happened. The exact same thing. The value is built off of those factors that I talked about. Now, again, I say this again. The words I put on here, this is an oversimplification to how those options are valued, but not everybody needs to know about all the Greeks. And again, right now, here's what the current market is in terms of premium to be able to buy each one of these. So if somebody was bearish July canola and they want to protect a 742, which is approximately where it is right now, it might cost them $38 to protect that downside. Okay, so a lot of times people say, that feels a little expensive. And yeah, it is. It is because again, the volatility in the market right now and the amount of time that you have to pay for these options do start making the sticker shock on these a little, a little real on that side. So, but we're going to
Barry
talk a little
Rutledge
bit
is
about how.
asking, while most put and calls have no margin call, explain how or when there is risk of margin. Example, war.
Okay, so if you buy an option, you have no margin call risk whatsoever. you have just essentially, the only risk you have is the premium that you paid for that option. Okay. But if you sell an option, you now have a potential margin risk. So if I was, in my previous example, if I was bearish canola and I sold an $800 call, if the market appreciates closer up to that 800 and that $800 call becomes in the money, then all of a sudden I would be subject to potential more margin calls from my broker. That's where it's the same as using, buying or selling the straight up physical commodity at that time.
Great discussion. We're 35 minutes in. Thank you for all the questions. Ryan, can we get to the strategy here and then get talking to Derek a bit?
Yes.
We want to get to David too. So let's expedite this a bit and get to her.
Okay, so quick on this side, put options used as price insurance. This is how you can secure a floor price without selling to the elevator. If you are have anxiety about contract cancellations because of a production shortfall, that's exactly where puts help you. That's exactly where puts help you. And this is a market where, hey, the value is becoming, within range on doing these things responsibly. You can buy or sell these options out of the money. And the main thing I would say to everybody is if you buy an option, you don't need to hold it to expiration. So for example, if you bought a November put option now for $49, but then you only need to hold it until June because then when you're comfortable in selling some physical, you might be able to recover $30 of that $49 that you put out on that option. And I put it to context in this and everybody. Imagine if you could, on August 1st, get 40% of your crop insurance premium back because you're no longer worried about a drought risk at that time. Okay, you can't do that with your cropping insurance, but with an option, you can sell that option back and collect some of that premium that you paid back for it. So again, very, very flexible to use. Here's the current option market. Not everybody may be able to see this, but this is approximately the values of the November market, calls and puts on this side. So the thing that we're going to be talking about here today, guys, is how to cheapen up some of these options. Okay, so I want to go back to this chart. Here's the at the money, approximately 720. And, to buy a put on November, 45 bucks, 48 bucks in this range. But if you're willing to buy an out of the money put, so something further down in this range, in this 630 range, okay, you might be able to buy that for a little bit cheaper, something like 12 or 11 bucks, but you're also taking a much lower floor. So that'd be one way to make these options a little bit more cost effective on that side. All right, so again, example, maybe you buy a 660 November canola option put for 20 bucks. It establishes a floor for you for about $14 a bushel. There's absolutely no upside price restrictions on this. If the market goes up to 850, you are able to collect all the upside above the 660 on that side. The only risks that you have is this is a lower floor price on your production than what you currently have right now. And most of the time, out of the money options do expire, out of the money options do expire valueless. So those are the only risks. You're less likely to get an output from that $20 you spent.
Well, and you could have bought this premium a month or two ago and it would have been super cheap given the volatility. Yep. It's that there's such high volatility, it's probably going to cost you twice as much for the same put. That's why you want to sell volatility against it and insure it if we can. Yep. Is that fair?
That's exactly it. So that's the next strategy that I'm going to be talking about. But this is essentially the line on the chart. This is what you'd be protecting right here by buying that, just buying a straight up out of the money 660 put strategy. You get all the upside if this thing rallies above 700 all the way up to 850, those things. But the worst case scenario you have on your farm is the 660 floor. And if you look at the period of time here that we've lived under 660, that's actually pretty good. Most of the time we've been under 660 over the last 3 years. Only over the summertime right now we've been materially above that price. And then again 3 years ago when we were still kind of on the downsides of that 2021-22 rally.
We had a few more questions coming in here and I want to get to this role playing. And I don't know how many more slides you had there too, but I wanted to get the other panels in there. Okay, maybe finish those up and then we'll get to the questions. we want to talk to Derek. We want to, and I'm also prepared if we want to go a little bit longer if people want to learn. I know that people have other commitments, but it's hard to get through this stuff in an hour, I find, and it is really good information. So
Yep.
finish her up. We'll take a couple questions. We'll talk to Derek, talk to David here.
Okay, so the next one folks can do to try to cheapen up these options is use a collar strategy. So what a collar strategy is simultaneously buying one option and selling another option. So you're using the premium of the option you sold to finance the purchase of the option that you actually absolutely want. So this is a way to create a ceiling and floor type of price on your grain. So for an example, the one that's readily available to folks right now, you could buy a November $700 put option for around $35 a ton, and simultaneously you could sell a November $800 metric ton call option for $25. Total cost to you is about $10 a metric ton, call it 23 cents a bushel. And what this does is establish a floor price for you of $700 a metric ton, but a ceiling price at $800 a metric ton. Okay, so call it a floor of $15 and a ceiling of $17. Okay, so the only risk on this one is if that market rallies, like we talked about, way above 800, well, then all of a sudden you would still be selling at only $800 and you wouldn't get whatever the value, whatever the appreciation above 800 is. So the question that you have to ask yourself is what's the probability of that happening? Am I willing to take that risk? Okay, so potential margin calls could be in there as well too. So again, if this market rallies to $900, there's probably going to be some margin calls on that $800 metric ton call option that you sold. But over time, you end up getting that back as you sell your physical canola.
Well, and you can cover it if you have the inventory.
Exactly right. So this is what I say to folks all the time. If you can live with selling $17 canola, this is a pretty good strategy for you. Okay,
Can
now
you
you
live
just
with
have
that,
to
Paul?
that's exactly right. Now, most of the time, people can live with selling $17 canola if it's $17.50, but if it's $20, then they might eat their heart out on that one a little bit. But that's, again, you got to decide yourself, how many times have I been able to do that? Am I willing to put that risk out there? What am I more worried about?
Okay.
So visually, this is what this would look like. You protect. So remember that floor price on the previous one? We've just moved this up to $700, but now we've created a ceiling level here as well. So as you can see, even over the last 3 years, it hasn't spent almost any time over that $800 a ton, range on that side. So again, you got to ask yourself, what's the probability? What am I willing to give up for what am I willing to get?
Okay, well, I just want to take a break there because we got 15 minutes left here to the top of the hour, and say to Derek, let's get your feedback on this, and maybe you can inform us a little bit about what you did last week, and then I want to hear from David on like the next level. And for now, maybe if we could just get rid of the sharing, Ryan, if you don't mind, we'll just go face to face and talk this out, man to man. So Derek, what's your thoughts on this, and tell us about what your experience was last week with Ryan's coaching, and how do you view this as a producer?
Yeah, this is just another risk management tool for farms. That's how I perceive it. I'm not into getting into speculatory trading. I just want to protect myself against any major market fluctuations. That's mainly what I'm going for. And with Ryan's technical analysis, sometimes we try to get a feel for when we're getting close to the top of the market. And one thing with canola is that I don't mind doing some production contracts and sales on it without having the quality and grading risk. So that's one nice thing with canola. You do this with a lot of other crops, and you have a quality factor in there that kind of is a little bit of a wild card, right? Where canola, it's fairly straightforward. So I will make some sales that way, which is what I did the previous week. But I didn't end up doing the same situation that Ryan just showing there with the caller. I did bought a 700 put and sold a 800 call, and put myself in that range there, $700 to $800, $15 to $17 an acre range there. So another thing is I don't do it on a large amount of my production. So this is just something that's going to soften the blow. It's if the price drops down to $13, well, yeah, I've got a chunk of my production that's kind of locked in at $15 essentially. It's the same kind of strategy I have with a lot of insurances. I just look at this as just another type of insurance. Like I write a check every year for a bunch of property insurance for my house and my buildings and stuff. And best case scenario for me, that money's just gone and kind of wasted. I don't want my house to burn down. I don't want my pole shed to blow over from plow wind. That money's gone, hopefully. Then I don't have to claim on that. And that's almost the way I see the puts, is that ideally this money that comes out of my RJ O'Brien trading account for the put option, it just never gets exercised. That put just expires worthless, and you sell all your canola for 16, 17, $18 in the market anyways. That's ideally what is going to happen. But I realistically, I don't think that's going to happen. So I'm willing to spend a little bit of money to kind of insure these prices. It's the same kind of concept with hail insurance. I rarely, if you have a $500 an acre crop out there, you're throwing $500 an acre hail insurance on. Maybe some guys do. I think the majority of people don't. I just have maybe $150 an acre on that crop, and kind of softens the blow on a certain amount of the production if you do get smoked. So I take the same strategy with the wheat and canola markets here. I generally grow more Durham than wheat. I'd say 9 years out of 10, Durham and wheat market are going to correlate fairly strongly together. So buying some put options buying a put option in wheat is not a bad strategy. If we do see a little bit of a run on wheat prices, I like to do the same thing with wheat, and then I kind of take out that quality risk. You sign up at number 1 or at 2 Durham, and then you have some type of a quality issue, and if your quality discounts or your grading discounts aren't laid out perfectly defined in those contracts, you can sometimes get yourself into a situation where you just like, oh, I wish I just would have done something different rather than actually signing up that production. So so that's just the kind of the mindset I have when it comes to this. When I decide to buy a put option, I'm kind of almost hoping it just expires worthless, but it's there if the market does collapse.
Yeah, and when in doubt, split it out. It doesn't have to be all or nothing. I'm sure Ryan coaches that. But David, how can we make this strategy even better, if you can believe it? Greg Bosch just said, love the strategy. Only drawback right now is a very real basis risk. How can we make the strategy even better with production insurance?
Yes, I think like everything Ryan and Derek are talking about, like we want our customers to be managing their downside risk, capturing that upside potential. So I love the cap and collar strategies. There's 2 things to be aware of. So with Global Ag Risk Solutions, so our production insurance, if your contract on your cap and collar that Ryan just described is with your StoneX or RBC trading account, that's paper. It's not tied to delivery. That is outside of your Global Ag Risk policy. So we don't include the cost of the strategy or the potential upside as a revenue. So it's essentially ignored from Global Ag Risk Solutions, which means if you win on your paper trade but lose on the physical, you can end up essentially triggering a Global Ag Risk claim, but getting to keep the money from RBC or StoneX that you've accumulated in your trading account. And so you're ending up sort of double dipping. So your downside is protected in the physical, but you're winning on the paper side. The reverse of that is that if you decide to make that trade tied to a delivery contract, because as Derek said, you might be worried about that delivery window, you need cash flow. So you've tied that contract, and you could do a similar strategy at Cargill today, and they'll tie it to a delivery window. If that grain is tied to a delivery contract of physical grain, then it is part of your Global Ag Risk contract. And the benefit of that would be that you're worried about non-delivery penalties. So if you're got that Cargill option strategy in place, but you don't grow the crop because of drought, or maybe it's a quality issue, you don't meet the specs, and you have a non-delivery penalty because you can't deliver on the grain that you promised, that delivery penalty is part of your Global Ag Risk policy. And so you would, if you're in a claim situation, which you probably would be if you had, you weren't able to deliver grain against your contract, it would make your claim with Global Ag bigger because of that non-delivery penalty is part of the calculation. So I think it's one of those ones where you can choose which way you want to participate in it. If you want that non-delivery protection side of it on a physical delivery, you put it into through one of your elevators and you tie it to a delivery contract. If you want to just win on the paper side and have your downside protected on the physical, then you can kind of play it outside with your RBC StoneX trading account. And I think both are good options. You just have to understand how they'll interact under different scenarios. And then at the same time, right now, we've got a lot of producers who because of the high commodity prices that we came off of in 2022, 23, as we're coming down into this new reality of lower commodity prices, we're seeing guys that have a high likelihood of triggering their AgriStability because the Olympic average is still quite high. So their AgriStability is likely to trigger. The cost of your options, regardless of whether it's tied to a delivery contract or paper, is an eligible AgriStability expense, as are the wins and losses inside your trading account are eligible revenue, or eligible, like if it's a loss, it would be essentially negative revenue. So your option strategy is protected by AgriStability. And for a lot of guys, that AgriStability is actually, tied basically up, near 100% of their projected revenue. Now, if they aren't going to collect on their AgriStability, it probably means we've had a great rally in commodity prices, or they've had, a monster crop, and then AgriStability may not trigger. But we're seeing that on a wide swath of customers that AgriStability is actually not down as a disaster relief program. It's actually up near their projected revenue for the year. And so that option strategy that cost you $10 to implement, that would be essentially an eligible expense. It's actually a negative revenue, but works the same way. And so that cost might be subsidized by the government if you're going to be in an AgriStability claim, 80 cents on the dollar. So your $10 strategy is actually net $2 if you trigger your AgriStability, and a lot of guys are going to.
Isn't that a quadruple dipped ice cream cone? If we've got the option strategy, then we can keep the upside of the option strategy, and we got GARS, and then but only if it's on the downside, and then we have AgriStability. I'm amazed and kind of jealous of what's available for farming businesses if you can farm the program. Not that farming's easy, but I was joking last time. You can't get that in the podcast world. Go ahead.
Yeah, can you clarify the revenue from the trading account? That's allowable income though on AgriStability, right?
Yep, it is. So
if
you're claiming the cost, you also have to claim the revenue.
You also have to recognize that. You'd have to recognize that your revenue from the trading account. So in AgriStability, in that situation, you're not just being able to expense that option. You'd have to recognize
depending on you. So it would be cut off. So if you have a December 31st year end, your option account, it's only on the actively traded commodities. And so depending on how you're using your trading strategy, if you're have a huge amount of options going in and out, and you've got a lot of positions, you might have a lot of money being accumulated or potentially lost on the trading account. The softer approach of just buying an option and then it expiring worthless, that is essentially a cost. Like it would be a negative revenue, but those costs are eligible expenses. So it's depending on, are you accumulating money in that trading account because you're actively taking a position, buying long or short, or are you just using options and it's probably expiring worthless, or so you hope at least that they expire worthless. Will depend on, is there an offsetting revenue gain on your AgriStability? So yeah, you got to understand both sides of that equation for sure.
Can you break it down if oh man, this is technical, but if the short put is say $37 and you sell a call, or no, you're going long the put at 700 and you're selling a call at 800 and you pay 37 and you collect 10, you're down to $27, and you got to pay premium on the GARS, but you're insured. Can you quantify that in dollar value in that example? What that's worth?
I'm not sure I follow the example.
Yeah, anyways, forget it. That's why we have professionals. I'm just a podcaster.
Yeah, one of the things is exclusively a price mechanism movement where GARS with David is total revenue. So there's a
It's all
production.
revenue, including so many bushels you grow times the price that you actually sell it for, and then the marketing wins and losses tied to those grain deliveries are part of the total calculation.
So it's a pie. It goes into the pie kind of
Goes
thing.
into the big pot, yeah. And it's whole farm too. The other side too, I think, is to recognize is that we can do this on wheat and we can do it on canola. Maybe Derek might do it on Durham wheat using the U.S. market as a proxy. The other commodities though are essentially you can't hedge them actively in the marketplace. So we oftentimes on some farms we can offer sort of a whole farm put on your basket of all of your commodities using global ag as sort of that floor. You can't get worse than your floor. It is a combination of the yields and the prices that you experience, but you can't get worse than the floor. So it's a way of thinking about it would be that it's a whole farm put,
Yeah.
but it includes all of the crops, including the ones that you can't put a put on, that aren't essentially wheat and canola.
Is anyone's head hurting at this stage? I know mine is, but I love it. It's such an interesting, complicated puzzle. And I just want to take a breath there. We are going to get to all the questions, but not everyone can stay. So I just want to ask, and this will be private. I'm not going to put that out there. But if you want to be contacted by a GARS rep to discuss further, just put yes into this poll. And then I believe I will be able to follow up through the magic of however computers are built. I mean, I'm not totally sure to check later via the microchip with who wants to be contacted about this strategy. And again, it's not that the GARS folks are doing these option strategies. It's a small rarefied air handful of folks like Ryan.
And I would say, like with our strategy is that we're experts on the insurance side. We know more than the average bear on AgriStability and how it works. We understand, the production risk, but when it comes to these option strategies and it comes to this marketing side of it, we defer to the experts. We want people to work with guys like Ryan that want that expert advice because it would be very dangerous to take commodity trading advice from a guy like me. I am woefully unqualified. And I would say the majority of my advisors would also be unqualified. So we need those experts like Ryan out in the field to connect us and make these calls and these puts and using these strategies, but understanding, I think Ryan has a leg up with global ag because he understands our product because he used to work for us at one time. That we can, how will these products work together, and we can actually model it all out and look at different strategies and scenarios and understand the larger picture. But it's part of this is that the world is unpredictable, and like I don't know if anybody was predicting nearly $800 canola a month or 2 months ago, which is great that we're getting there. We're close to there. We're 720, 750. The basis is wide. It's gross, but that's probably a function of we grew a monster crop last year. So they know there's lots of canola out in the countryside, and a lot of it's got to get delivered yet. But at the same time, if we can protect the downside risk, I think that's a great position to be in when we see this volatility. And there's probably going to be some more opportunities this summer as we get into a weather market where we can protect that downside risk by picking off these spikes that happen from whether it's war or weather.
Awesome. No, well, we're at the top of the hour. You got the gist of it, folks, for anybody who's got to jump off. But we are going, if the participants here can continue lending us their time and attention, then we'll continue workshopping with the folks that want to stay. I think, is that fair? Is everybody on board there? Derek, I'm appreciating your feedback and perspective, and let's keep going here. So I'm going to go back up. We're a little bit behind on questions, but I appreciate it. So anybody who's got to jump off, thanks for attending. Let us know if you have any follow-up questions. Ryan, I could also put your can I put your information in the chat, or is it like they gotta like what?
Yeah, I would just say if anybody wants to contact me, yeah, phone or email is the easiest way. But if you want to throw in my email in the chat, go right ahead, Dan.
Okay, I will maybe do that, and I'll maybe throw Ryan's in there too. Derek, I don't know if you want to be famous on the internet, but
anyone needs to contact me on anything this So that's fine.
I'll put your Hotmail in there and they can. Um, hey, I'm a Hotmail dude too. I got the old Hotmail there,
This
right
is
up
the
there
one
with
that
it.
gets spammed the most. So like anytime there's something like this, it's just like, yeah, use that one. It can get cluttered up.
It goes to the I really care about you inbox.
Yeah.
Tarek Wilderman is asking, what percent premium do you like to target when buying options?
Yeah, I'd maybe shift that a little bit different for growers. I generally look to implement option strategies at a cost to the grower at about 25 cents a bushel is my normal kind of range of, best thumb range on that side. The reason why is I find once we get over that, we need a much larger movement in the market to start making these things worthwhile. And I've noticed a lot of time most guys don't want to pay that much more than that. Okay, so for example, if somebody, a current at the money put option being like $48 a ton, which is a dollar something a bushel, that might have value in it, but that cost generally does kick people out of it. So I look for something about 25, maybe up to 40 cents a bushel range. And if we can get them under 25, if these strategies that make sense are under 25, that's you could get more aggressive on that side. So that's canola. Now wheats, for example, is the other one that we can use here. I generally try to keep it even a little bit tighter, 15 to 25 cents at the most, because we don't generally get these big moves in wheat that start making these options worthwhile. Sometimes on wheat, the better thing for you guys to do, put it in your bin, hold it, market it at a later time.
Love it. And I'm just going to go back up here. Steve Manning is saying, do you find most of your clients use options as an insurance policy only, i.e. a sunk cost, or do they expect to capture actual value from the contract? Most options expire worthless, so I would assume insurance.
So we go into it using an insurance mindset, just like Derek spoke of. But no matter what, if we get on the right side of these options, like if the market does move that way, the way that we think it might, it is very, very difficult not to become a speculator. Okay, so I'm going to give an example on this one, and this is going to square the circle on a couple of these things because another gentleman asked, like, how do we, turn this into a physical, into a physical sale into cash? So if you're buying that option strategy right now, what you are literally holding that for, if you're doing this as a hedger, you're holding it until you are comfortable with your crop production that you can then turn that into a physical sale. So this is what I ask everybody. It's different for everybody. Maybe it's July 10th for one guy because they escaped hail season in Alberta, and maybe somebody in southern Saskatchewan is August 1st, and maybe somebody's more conservative is it's not until it's in the bin. Each one of those answers are right for when you're comfortable with your production. But as soon as that switch happens, and that's kind of a moment in time, you should look to turn this strategy into a physical sale. If you are comfortable selling $700 futures and we're down at 600, let's say fast forward time, we're July 20th, my consultation to somebody would be like, you should look to turn that into a $700 sale. Now, no matter what happens, it's always going to be, well, is it going to go down? Could I get more out of this? Could I double dip? That particular conversation happens in real time, and you just have to write down what your intentions are at that time, because otherwise you're going to get into that speculator mindset, and that's when you can get burnt.
Derek, do you have any comments on that?
Yeah, no, I agree with that. And Ryan, we've talked about this too, that sometimes that exact day that you make that sale, theoretically, if you're strictly in for hedging, that same day you should make the movement in your trade account. Some of us think, well, you know what? I think there's maybe a little movement here. I'm going to hang on to it for a couple of weeks, and then you're into speculating territory. So, like you say, we always start off as doing this for hedging and an insurance type mindset, but then maybe you decide, maybe I want to play around in this. I made my canola sale, but I'm going to hold on to that option because I think I can maybe squeeze a little bit.
Because you're so smart, hey? You're just feeling smart that day, and you're like, oh.
And also for people who are interested in the just watching commodity markets and speculating and stuff. I like to watch them. It's more almost a hobby. I don't really get into things that I'm not involved with, but Ryan has a lot of interesting strategies on spreads between beans and corn and when things get narrow and wide and taking different positions here and there to try and just make a little bit of money that's basically on a speculation basis. So he has these strategies as well that he will pitch you and say, hey, if you want to play in this, I think there's an opportunity in this area to make a little bit of money. And it really doesn't have a lot of relevance to hedging the commodities you're growing in the farm, but he'll identify opportunities that way as well.
Well, that speculation is not included in your AgriStability.
Yeah, that's right. That's right. That's not. Yeah, I don't think you'd have a
upside investment.
Downer, David.
Yeah, if I handed in.
What if you forget, David? What if you just it just ran a bit long on me? I got distracted in the lineup at the elevator.
I also have it. I'll just touch on someone mentioned something with fuel in there as well, and I'm just gonna bring a real life situation that a lot of I've been watching heating oil futures on the exchange, and I want to actually take my spot prices of fuel, just throw them in an Excel spreadsheet or AI bot and run them against the heating oil futures, convert it back to Canadian dollars, obviously, and see what the correlation is between spot price of diesel fuel and the heating oil futures, the nearby heating oil futures. I think it's going to correlate really high. There seems like there's a few fuel dealers out there that will do some forward pricing, but a lot of them don't. It just doesn't work out. I've asked them about it, and they say it's just the amount of volume we have to purchase and then try and sell that volume all before the market moves. It just makes it too hard for us to offer, an August, September fuel fill for you right now if you want to do that. Some of them are doing it, some of them aren't. So I just got thinking myself, if I prefer to deal with a certain fuel dealer and they're not offering that, maybe rather than changing fuel dealers to someone who does do forward pricing, maybe a strategy like this is as well. And do we just get into the option thing as well? I want to protect myself for a situation that's just happened in the last month for harvest. So let's go and I guess in that situation I'd be buying a call, right, Ryan? So I'd buy a call 20 cents above the market, and if and it's in prices per gallon in the States. So yeah, I think it's up at last time I looked 380 or something, 380 a gallon, depending on what month you're looking at. But it was only 220, 250 not that long ago. So you could have bought a 250 call or something in a September futures heating oil market and protect yourself against something like this. But that's pretty hindsight. But something that I could consider in the future if we don't have that opportunity to forward purchase fuel from every dealer.
I was in a seedy bar on St. Patrick's Day at 2 a.m. and came up with a brilliant idea. But it was the right now, like we got our canola cap and collar, but we also need to put for 2020, if you haven't bought your fertilizer for next year for 2027, to have a cap and collar for your fertilizer, for your nitrogen fertilizer. Because like if we're hedging one, we should be hedging the other. If we're leaving the fertilizer unhedged, we're exposed to all that potential acceleration of price. And then the same thing on the reverse. Like if we take a position on our fertilizer and it's at, I don't know what it's going to be, $1,200 a ton or $1,400 a ton, but then maybe the wars all get sort of solved and peace around the world again. Well, that fertilizer might drop to $800 a ton or $600 a ton, and we're not able to, because we've taken physical, we've committed on it. We aren't going to participate on the other side of it potentially.
Yeah.
Yeah, there are mechanisms
Trump
to do
gets elected for a third term.
Yeah.
Yeah, like
Sorry, go ahead, Ryan.
Yeah, there are mechanisms to do it. It's just a lot of the time the volume in these contracts, and to Derek's point, you want to find one that's most correlated to our current cash market. That's the more difficult thing to be able to do on these. So none of these options on like say a fuel fertilizer is perfect. Okay, but if you're willing to absorb some risk when fuel RBOB turns down or something like that, you could buy a put on those ones to protect yourself as that market goes down if you had to buy at a higher price. That is available to you. The brokers that you'd use, you do it, but it's not perfect to our market. Okay, it's kind of like using, as an example, you might have to use Kansas City wheat options to hedge a Durham contract. It is not perfect. There's so many more things that could happen in Durham, quality spreads, those type of things. But if you wanted to hedge a Durham price in the futures market, Kansas City is probably your most likely one because it's got the most volume and the most liquidity. Minneapolis has almost negligible liquidity, so it's hard to do it. So it's not perfect, but if somebody is willing to absorb some risk, you could do it.
That basis risk is essentially what's being created there. Would be same discussion on the fuel side about trying to see if there's a correlation. Same thing on that fertilizer side. Is there a correlation on that? Is it Chicago that fertilizer's traded out of?
Can't remember now.
Yeah, whichever market that fertilizer traded out of, but you can trade urea, probably NOLA, I'm guessing. Take that and correlate it to our local spot price in Western Canada. And if there's been a historically tight correlation, there's always supply blips here and there, different things, but it is a global marketplace. So I would hope that there's a tight correlation. The guy could then offset it. You commit to that crazy expensive fertilizer for next year. Hopefully you're committing some tons of your production to next year to offset that risk of taking that expensive fertilizer. But maybe there's opportunity to win if the world gets straightened out.
And like what I'd put out to everybody too is like it's not going to be perfect, but neither is, say, buying like a 60% insurance package. It doesn't exactly perfectly hedge you, but you're absorbing some of that risk, but there is still ways to do it. So if you can accept that, like it's possible, it's just not going to be perfect.
Next week, I'm having Mario Gadet from Busy Sul on for a fertilizer rant. When he started with Busy Sul in June of 24, sulfur at the port was $70 a ton. Today, it's 600. And sulfur, people don't know it, but it makes the world go around. It's the most ubiquitous thing on planet Earth used in mining and manufacturing, food production. And it's just crazy to think it's 10x. So we're going to talk about that. But if you can hedge things like that too with fertilizer, that's wild. Barry Rutledge is asking, Dallas Klapstein is asking, just curious, when you sell in fall, how and when do you exit these option strategies?
Yeah, so we spoke about it a little bit earlier when you decide to, turn that into a physical sale. So what you do is, let's say you had that $700 put option, $800 call. Let's say it was down in the money. So what I mean by that, the market has moved down, and let's just say it's $600, 650 futures. Okay. At that exact time when you decide like, hey, I'm comfortable with my crop, you would sell your physical grain at that time, and you would at the exact same time exit your put option strategy to make it a perfect hedge. So you do it simultaneously. You'd sell to the elevator and you take this strategy off and you've perfectly hedged yourself. Now, again, we always get into this conversation. Hey, do you think it's still going to go down? Should I hold on to this? I'm selling that. That will happen. There will be some overlap on that one. No matter, like you can't escape it. You're part of humanity, but you do it simultaneously. As soon as you're ready for that crop sale, you get out of that option simultaneously. You've perfectly hedged yourself.
I would argue the professionals all have a plan on this and it's written down somewhere and they're not reacting emotionally. If you're reacting emotionally, you're not a whale, you're a minnow, or you're going to get eaten by the sharks. So, because the big boys know where all your stuff is. They know where all your stops are. If you been watching the silver market, they had a nice lunch and the chum in the water the other day.
Actually, can I expand on that one too? So this is the next question people ask. So for that example I gave you, let's just assume basis is out of that. You would get $650 for your physical canola, and then you would have $50 a ton of profit in your hedge account for the $700 floor that we spoke about. So think of like my bank account is in my physical sales, and then I'd also have my hedge account on this side. So you'd get $650 from your elevator, and you'd have $50 a ton in your hedge account. And you could choose to pull that money out of your hedge account into your bank account and use that liquid cash.
Is that what happens in your life, Derek?
Well, usually mine actually expiring some of the options. We made some money on some wheat options a few years ago, and I actually got out of them, a little bit before the sales I made. But I haven't executed a whole bunch of them perfectly. Like say, a lot of this is just a price insurance thing for me, and it's not always directly hedged. It's only a percentage of my production, and And that's, yeah, but theoretically, the way Ryan said, that's kind of how we usually do it. Once you're comfortable where the market is and you have a crop and stuff, then you'll exit the position. And whether or not I make that sale exactly that day, it's, yeah. But again, I'm usually only a percentage. I don't know what percentage it'd be, but of my production is traded or has an actual option backing it. So
Got it. David, you had a point?
Well, if you're, your 5,000 acre farm example, you got, $2.5, $3 million worth of grain, either in the bin or grain that you're going to grow. If you don't have it hedged, you are a market participant.
Right.
You are participating. You are just long. You are way
You
long.
are really long, man.
If someone was to say they had $3 million of wheat and canola long in the market, most traders would choke, but you actually are, because you've chosen to not
Yeah.
hedge against any of the downside potential on that. And I think if
That
a
is
guy
a
was
position
that
in itself.
long,
Yeah.
if a guy was that long on paper, he probably would have some strategies in place to limit that downside. Yet most producers in Western Canada don't protect that downside on very much of their crop. We see 5-10% of it is marketed at this time of year. Sometimes zero is marketed at this time of year for new crop. That essentially, as soon as you start putting that seed in the ground, you are long.
Well, I'm talking to farmers for the last 3 decades. There's a lot of folks that will lock the bins and speculate that it's going to go up, and then they'll sell, and they can afford to, and maybe they win over the long term. But Ryan, did you have anything to add on that before we get to the next question here? Or?
No, and this what I'd say is having bins and locking your bin is not it's not a terrible decision sometimes. Like,
Right.
I don't want to
Yeah,
make everybody
for
make
sure.
it sound
No.
like, hey, you got to do these things all the time. There's many times I just suggest to my growers, just keep in the bin, you're fine. This market's rallying, you don't need to jump out and do these type of things all the time. Where these strategies really fit is in, like, almost ideally in a market right now. Like, it's almost ideal. Without this war happening, we would not be here. Make
Right.
no mistake about it. Okay. These are the type of opportunities where I stress to my clients, you need these accounts available for these type of opportunities, or in the middle of summer when you are anxiety filled of selling the next tranche of grain. That's when you'd want to be using these things. So it doesn't mean
Volatility is opportunity, right? Like, that
exactly.
is when it's calm and it's just bouncing around, there's really nothing you can do because the price of those options is not attractive. When there's volatility, you can create, wins up good, volatility up and down. There's, ways to make money both ways.
Exactly.
Riley Wallace is asking, every marketing company I've ever worked with pitches these strategies, but everyone forgets or doesn't explain that the hedge needs to be closed at the time the physical sale takes place. Ryan did touch on this, but most farmers, including me, are guilty of turning a hedge into speculation.
Yeah.
Yeah.
So what I've noticed, and I'm not demeaning any company out there, they have individuals advising you to get into these things, but they don't walk you through how or when to get out of them. And this is what I'd say on that side. Most of them don't follow a particular set of parameters or a strategy. Okay. They're just out there trying to buy your grain. Okay. Whenever we do things within my clientele, there's a certain set of parameters that have to fit and have to be true for us to say we're going to execute this. And then when those parameters no longer are true, we get out of it. Okay. So
Right.
to this comment is, hey, you might get into this strategy here today for this reason. Okay. But then what is your strategy to get out of it? What are you looking for in the market to tell me now is the time to get out of it? The easy one is, I'm now comfortable with my grain production. Okay. But maybe you're comfortable with your grain production on a day where you should not be getting out of that. That is the next step in these things to know when, hey, is this the best time to be exiting these things? Okay. So there's certain indicators I look at to get in, and there's indicators I look at to get out. And I would stress this to everybody. Everybody should have some type of strategy or plan around those things, not only on hedgeable commodities, but on feed barley, lentils, chickpeas, you pick it. You should have some type of parameters on, hey, I'm going to execute when these things are true, and I'm not going to execute when these things are not true.
For example, before you go into a bear call spread on QQQ, you might say, I'm going to sell at 50% profit, or going to close that trade at 50% profit within X amount of days. given it's a 35 days to expiration, or I'm going to have a stop loss at 200% risk, right? And
Yes.
but do you understand the probabilities of the deltas? And that's where guys like Ryan come in, and we should work with them that are going to be the whole way. But I can see that's a pain point. Barry Rutledge is saying, Ryan, we are looking at income side of farming. Are you doing anything on the fuel, fertilizer options, recovery expense side? We touched on that a bit. Is there anything to add?
I don't do it. I stick into my realm of I don't want to say expertise, but comfort. The reason why I don't on ferts or fuel is I think there's only about 5 guys in all of North America that could accurately predict the fertilizer market. And I think they all have chiefs in front of their names and nobody ever gets to talk to them. You follow any fertilizer guy online.
What about
I
Josh
don't find
Linville?
Josh is the best out there, but even
Right.
Josh even says, he's like, I don't know where
Yeah.
this thing is going.
Yeah.
So that's a tough thing on that one. So I don't want to step into muddy water where I don't feel as I've got expertise. And on the fuel side, like it is possible. I'm looking more and more into it. But again, it doesn't fit our markets as well. Like some of the hedging mechanisms, the basis risk on our markets is too high for me to be able to do it accurately or comfortably for growers.
Yeah, and then you're into some speculation, but good questions.
Yeah.
Do you offer, Carol Strobel is asking, do you offer options to hedge against interest rate movements?
I don't touch on any of that. You'd have to go to the bank to be able to do more of that. I think there's some mechanisms that they use, but that is well outside of my realm of expertise.
Barry Rutledge is saying some traders look at re-owned grain to cover upside after physical sale. Is this not just a pretty way of dressing up speculation?
Yes.
I love it. Ryan Herring is asking, one thing to consider on the collar strategy is that if the price would go over $800, you are in a margin call situation. In this environment, we're in the likelihood is there for sure. If it did, it would likely be short-lived, but should be noted for sure.
Absolutely.
Mm-hmm.
Back to that owning grain thing, we've heard people that if there's some type of a storage risk or you just want to move it, you need the cash flow, but you really don't want to get out of the market, then I guess it is technically speculation. But if it was something that you didn't really ever want to sell, you got grain bags out there, the deer are ripping them up, it's December, you just want to get them in there, you didn't plan on selling it, you're really bullish on the market, buying it back on paper. What do you think about that, Ryan? Like it still is technically speculation, I guess, but in that type of a situation where there was some type of a storage or cash flow situation.
Yeah. So agreeing with both points here. If you have it in your bin, you're sort of speculating. Okay. So if you have it on paper, you're speculating as well based on what that market is to go. But to your point, if you want to sell it at an inopportune time, which a lot of guys are forced to, unfortunately, not always is everybody planning as well as they should, and they're selling it sometimes in inopportune times. So replacing it on paper at that time is not an unsound strategy. Okay. But when folks are just saying, I'm just going to dump everything off combine and re-own that on paper all the time, my question is why? Give me the reason why you're bullish and how bullish you are, and then we can have a better conversation around that one. Quantify how bullish you are on that side. Then I can say, hey, are you a speculator or a hedger at that point? But again, strategy is there, but again, there is a degree of speculation.
I just think it's so fruitful to work with someone like yourself, and Derek, kudos to you. Your name always comes up in these things as someone who, like our previous guest, Jake Legui, has a really good handle on things, and at least having the awareness. There's an infinite amount of strategies in the option world. And not everybody, just like not everybody's mechanical or into agronomy or into the finance or into the HR, like people have different skills, but working with professionals like yourself, Ryan, Derek, what kind of difference does that make over the long term for your business? It's gotta be a big deal.
Yeah, I generally have always been interested in this and watch it sometimes, but I'll, like everybody else, then you get busy in the operations end of your business and you're not really watching. And then you get the text or the email from Ryan and, hey, just a heads up, did you know that canola did this? And there's and he points out identifies those opportunities, because sometimes these opportunities are very short lived. So if you don't, we don't all have the time to be sitting and looking at bar chart with the ads popping up at us every 30 seconds. Click them off to see and try to look at what the options price are, and yeah, so working with a guy like Ryan, that's where it's yeah, he's his eyes on the ball all the time, so he can identify those opportunities and then also give you the backing. Like to me, it's kind of sometimes a gut feel. I'm like, I don't think this is going to go any higher. I think this war in Iran is almost over. Man, I think Trump's going to blow the whole place up and things are and go bring it back to, well, let's keep in mind that the fundamental, and right now the fundamentals of the canola market, like say there's a huge supply of canola. There's all these actual, if you take it as its own individual market and look at the fundamentals of it, it almost seems to me you'd have to be bearish on that. But there's so many outside factors influencing it that the actual market fundamentals of it maybe aren't that important when you got the things going on around the world right now. And Ryan can bring all that together and put it into context and give you a more of a technical reason as to why things are the way they are right now in the markets.
Final word, David.
Yeah, we're in the middle of quoting and selling our insurance. Then this is the conversation that we're having it with, almost every customer. We've had this run of decent commodity prices the last number of weeks, which means we're able to make really attractive offers of insurance relative to what we were able to do, say, a month ago. And that means that, it's a good time to buy. On the same time is like, okay, well, take advantage of locking that in and take advantage of that buyback protection if you end up not growing a crop for one reason or another. So that, we've came to the market with, we've got our traditional products that work with these marketing strategies. And then we've brought in our Yield Plus option, which is much cheaper, works with your traditional crop insurance. So essentially turning your crop insurance with our Yield Plus option turns it into a global agri-risk policy and lets you, have the market protection that the traditional global agri-risk product offers, but at a discounted price. And so, I'm expecting that we're going to sell out this year. We're having a really good sales season, but there's still time to get in, get a quote, look at your options, understand how it's going to work with your marketing strategy. This is the time to do it. And, my guys are ready. We're able to turn quotes around in a day or two this time of year because we've got all the bulk of our retention customers have already got their quotes in their hand. So now we can focus on new customers and we're ready to do it. I think it's my 10 years of being in this business, I think it's we're offering real downside protection in a market where there is real risk of downside because of this is global politics, wars, these types of things. As fast as they turn on, they turn off. And we're able to sort of hedge that using an insurance option. And let's not forget about all of the other ways that we could also hedge it. I think it's a bigger conversation that needs to be had, at the kitchen table.
Well, and if you aren't talking to your trusted suppliers and not being made aware, then maybe there's an opportunity that's been missed. And I think Barry Rutledge put it well. Good on you, Dan, to attract presenters smarter than you. I'll take that win. Raises all boats. Sure as hell does, and it's a huge honor to talk to all of you. I've really enjoyed this. And Ryan, how's your experience on Growing the Future been so far on a scale of 1 to 10?
Yeah, 10. This has been excellent. I love the farmer interaction. It's great to get real-time questions on these. So
It is great. It's been a great conversation. Okay, well, I see my little brother calling here. Look at that smiling face. What a handsome guy. Hey, Dad, what are you doing?
Yeah.
So that's probably a good place to wrap up the webinar. Thank you, Derek Tallon, for coming on. I appreciate you. Let's do it again in the future. David, thank you for having us and making this possible. Thank you to GARS for sponsoring this. And Ryan, man, we got to do some more work together. I'm just a junkie for this, all this technical analysis and trading, everything. So Kevin Hurst said, great session. Hopefully we'll make it into the Western Producer. And let us know how you're